All right, everybody. Stocks by the numbers. Welcome back. Quick update. PayPal Holdings, ticker symbol PYPL, listed here on the Nasdaq. 58.30 a share on the close, up a little over a point, a little less than 2% move here on the day, up a couple of more cents after hours. And the last time we looked at this stock was the tail end of February here, right around these earnings. So let's see what's been going on. We were in this long-term wedge here that we spoke about. Let me back up, right? We were in this downward trajectory here for a while. February earnings come out. We can see yet again another nice beat on the top and bottom line. We ran up to about 70 a share. Looks like potentially forming a head and shoulders pattern here, and then we broke down. Recently tried to get back above that neckline, retested this fib here at about 62, and we can see we had a slight rejection. We're coming back down. We could potentially see 56.39 here, this fib in my opinion, but overall I have to say again, in my eyes, this stock is really being beaten up. I feel like they want to bring it underneath the radar. They want everyone to forget about it. And in my opinion, I'm looking here longer term for this gap fill of over $150 a share. So we're looking potentially at, what, 180% move maybe long term. And it could take into 2025 and 2026 because it's definitely not going to happen overnight. I mean, the stock's been in a downtrend since the bull dropped in 2022. So we're talking about a 2.5%, a 2.5 year downtrend for the most part. But I drew out this big curve here, this light blue. I know it's hard to see. I have a lot of trend lines, but you can see, in my opinion, I'm expecting this long-term kind of U recovery back to this potential gap fill of $152 a share. If you agree, disagree, let me know down in the comments section. But the company, as much as they want to beat it up, in my opinion, again, the company has been pretty solid and consistent here on the earnings side. So they always try to act like, it shouldn't have a light a light shined, a light shined on it, a light shown. Anyway, it shouldn't have a light on it, right? That's what basically the narrative is right now. And that's why, in my opinion, I always say that you should look for brand name companies like this who are still steady, stable, consistent in the numbers, but they've taken a hit and now you could potentially buy them at fair value or maybe a discounted value. And in my opinion, this should really easily be like a $100 stock, but it's being held down here again, rejecting off the 70 level and hanging out at the 60s for a while. Now they're bringing it back down into the 50s. In my opinion, over the longer term, I would personally view this as an opportunity, not a negative. But we have earnings coming up again next week, Tuesday the 30th. Estimates on the EPS side, 98.5 cents, off of revenue of 7.816 billion. Now, first of all, let's check some quick fundamentals. We have a market cap here. We'll call it 61 billion. We're trading less than 14.5 times earnings. And this was a very, very slight miss here. If we go back, we can see, look at that, missed by half a cent, even though they beat nicely on the revenue side. And that's over the last 4 quarters. So we have 3 really nice beats and basically a meet. But of course, it's technically a slight miss over the last 4 quarters. But we can see, more importantly, look at annually how this business overall has been growing. Now, I understand the net margin percentage took a hit here over these couple of years after the lockdowns. Looks like we're making a nice bounce from 22 to 23. You can see net margin here about 9%. 2023 shoots back up to 14.3%. So that's like a 50% move in profitability from 22 to 23. Really nothing to sneeze at, but it's the climb up in revenue as well that, in my opinion, is a big green flag here for PayPal. 17.5 billion, 21.4, 25.5 billion, 27 billion, now up to almost 30 billion to close out 2023. So again, I appreciate the fact that some money may be flowing out of PayPal and people might be looking for other opportunities, but in my opinion, I think personally that these numbers look pretty solid, and I think it's really only going to be a matter of time before this stock rebounds. And again, just like we mentioned with something like a Rolls-Royce, they want to bring it down for a while. In my opinion, they want to take it out of the spotlight. They want to take it off everyone's radar. They want people to think it's not doing anything. It's a stick in the mud. And then when you're not looking, it's going to be back up to 80. It's going to be back up to 92, 95, 100. And then everyone's going to start talking about it, and it's going to be you guys, the retail investors that are kind of a little late to the party, that in my opinion are going to continue to propel it up to this gap fill of about 152.08. That was the low off of that candle right there before it bounced up and then gapped down. In my opinion, I know it's hard to see, I have a lot of trend lines here, but in my opinion, this light blue kind of U-turn, long-term recovery, in my eyes, that's what this stock really should do. And let's look at the numbers here. I'm going to show you why, excuse me, I'm going to show you why I feel this way, because the equity, again, total assets minus total liabilities yields total equity. And we can see the equity technically has been bouncing around from about 20.25 billion down to 19.6, back up 21, 27 here, 20.7, excuse me. So we're sitting here at 20.7 billion, right? Company right now, debt seems to be kind of hanging out at around this 11.5 billion mark. So we have 11.6 billion in debt, right? So 20.7 minus 11.6 would bring us to what? About 9 billion. We come over here and we can see for last quarter, company has almost 10 billion in cash, right? Also, this time last year, we had about 7 billion. You can see now we're up to 9.7 billion. But if we add those numbers together, we're looking at what, like 18.7 billion. The company is profitable, so you technically really can't subtract value from this revenue number, in my opinion. So we're at about 18 billion in change. They brought in about 30 billion in revenue last year. So if we add those numbers up, you're looking at about 48 billion, in my opinion, is kind of quote unquote fair value for this business. And if we look at the market cap, we're at 60 million. We're at 60 billion. So we're trading 1.25 times fair business value, in my opinion. Also, we brought in 30 billion, the market cap 60 billion. So if we do our revenue to market cap comparison, we're only trading 2x annual revenue. And for a mobile digital financial institution like PayPal, who's seen consistent steady growth over the last 5 straight years, in my opinion, a business like that in that sector, in this market, that is just consistently hitting highs no matter what the heck's going on, to be trading only 2 times yearly revenue, in my opinion, is a joke. And we can easily get that up to 3x revenue, which of course would bring the market cap to about 90 plus billion, which would easily bring us up to like 78, 82, $85 a share, in my opinion. And I do still think that is being conservative, and that would bring our PE ratio also up to about 21, which really isn't too excessive either, in my opinion. But overall, the fact that this business is being kept down, I don't want to say it's a joke, but also at the same time, again, I have to go back to my original theory, similar to a stock like Rolls-Royce. I think they want to kind of just bring it out of the spotlight. They want people to forget about it. And then when no one's looking, it's going to be 80, 90, 100 plus a share. And then people are going to talk about the phenomenal rebound of PayPal Holdings. Because even if we look at the forecast of a lot of these analysts here, and I understand this isn't set in stone, but we have to call it like it is. We have 39, 45, 46 analysts. Excuse me, 46 analysts currently covering PYPL. 16 giving it a strong buy, 6 giving it a buy, 23 saying to hold, 1 person, the outlier, saying they think it's a strong sell. Excuse me. Also, their price target is 57. The stock recently went down to $50 a share. So we basically hit that point, and after pulling back and selling off to this analyst's potential quote unquote, real fair value, should now probably start to turn bullish on the situation and feel that something like PayPal is trading at a discount. But overall, these analysts, we can see average price target $76 a share, highest price target $120 a share. I'm telling you, in my opinion, this is probably going to go back to triple digits over the long term. Look at this stability. You're going to try to tell me a stock like this should be kept down? We have one slight miss by 0.5 cents on the EPS side going back the last 8 quarters. Before and after that, phenomenal beats. Same thing on the revenue side. Look at this slight miss here, 0.1% back in Q4 of 22. Before and after, steady, consistent beats. And of course, on the annual side, just looking phenomenal. And moving forward here, look at the growth that's still expected. 7, 8, 10% year over year moving forward. 32 plus billion for 24, almost 35 in 25, 37.5 in 26, almost 39 billion in 27. I mean, again, the growth cannot be denied. And this is why I say, in my opinion, is it slow? Is it boring? Yes. Does it happen overnight? No. However, if you can buy brand name companies at discounted or fair values and tuck them away and accumulate shares and build a position for the longer term, chances are you have a very high probability, in my eyes, to secure profits. So right here at 58, again, I think the stock is easily worth 90 to 100. And again, that's being pretty conservative, but you can see the profitability expected to take a little bit of a drop here in 24 and then consistently climb up. But again, the company still technically is profitable and has been coming in above expectations on the EPS side more times than not, both quarterly and annually. So that's why, even if people see it dip down and say, oh, they're not as profitable as they, used to be a year or two ago, so that's why we're beating the stock up. In my opinion, that's still a joke, because even if we lower estimates, if a company comes in above estimates, then they're technically performing better than Wall Street anticipated, which should really translate to higher stock price. But, excuse me, I don't know. I might be getting sick. I've been clearing my throat for like the last day or two consistently, but just very quickly here, we can see if we look at some of these fundamentals, you can see, look at the PE down here, sub 14.5. That's the lowest it's been going back the last 7 or 8 quarters. Price to sales down here, 2 times sales. That's the lowest it's been. Cash flow right now, not here. Price to book, sub 3. That's the lowest it's been going back the last 7 or 8 quarters. The enterprise value, which supposedly is what another business would be willing to pay for it, for some reason has been consistently dropping. And the only negative in my eyes that has been consistently increasing that could potentially eat away at enterprise value would be the slight debt increases that they're seeing quarter over quarter. But again, in my opinion, it seems like they're outpacing that increase in debt with the growth in cash on hand quarter over quarter. So to take the enterprise value down from 100 billion to 57 billion over the last 7-8 quarters, when the company has been beating more times than not since then, in my opinion, I am just not understanding this at all. And this is why I wanted to take another look at the company, because in my opinion, again, I think we're potentially looking at something on the clearance rack right here with PYPL, especially in the longer term. Our return percentages slowly starting to climb back up. Gross margin percentage here at 39.4. It was a little higher, was a little lower also, so it's basically middle of the road there on, the mean average of the last 7 or 8 quarters. Operating margin percentage up here at over 18.33%. Now you remember over here when they beat it up and brought it down to new lows because the operating margin dipped down a little bit, and look, it's been steadily climbing. I mean, we're up 3 points off of 15 in 3 quarters, so we're up 20% from kind of this quote-unquote dismal dip in operating margin percentage a couple of quarters ago. We're up 3 percentage points, which is 20% of this value just over the last 3 quarters. So see, this is what I mean as well. You can't try to play both sides of the fence, right? Because I'm sure there might be 1 or 2 of you out there who might leave a comment like, yeah, it's down because of this, or in my opinion, I think it should be down. And that's fine. Of course, we're all entitled to our own opinions. We all look at these situations differently. But my point is, if you want to beat it up and bring it down to 50 from 70 and have it hit new multi-year lows because of a dip in operating margin percentage, well, look, now it's the highest it's freaking been for the last 8 quarters and has been rebounding and climbing for the last 3 quarters in a row. So if you beat it up from 70 to 50 because of a dip in operating margin, then on the reverse rebound and the rise in operating margin percentage, this stock should be 90 to 100. The defense rests. Let's move on. EBITDA, earnings before interest, taxes, depreciation, amortization, up to almost 22%. That is the highest it's been going back the last 7 or 8 quarters. The net margin percentage we see bouncing around from as low as 11%, getting as high as almost 20%, 17%, dipping down last quarter to 11.5%. And again, is it down? Technically, yes. However, they lowered estimates on the EPS side, and the company is still coming in above analyst expectations. So this is what I mean. You have to give credit where credit is due. And it's grinding my gears that a company like this is being kept down when they're coming in above estimates, and we have these other kind of no-name zombie startup companies who will, post a loss of 28 cents when estimates were a loss of 29 cents. And even though there's little or no revenue, the stock will explode 30% because they, showed more narrow losses than Wall Street expect. And that's what I mean. If you want to reward companies like that, who are kind of virtually doing nothing off of a slight positive fundamental metric, well, when something like PayPal reports and they beat earnings again, you have to give credit where credit's due. This is why I'm saying, again, in my opinion, $90, $100, I think it's a layup. And realistically, long term, I do think we turn around maybe two years from now. It might take a while, but I really do believe we turn around and the stock is back to around that $150 level. And in my opinion, I think it would be justified. We look at something like the asset turnover again, the amount of revenue generated off of said assets on the balance sheet. And we look, the balance sheet kind of stays kind of flat for the most part. Little pops and drops, but it's been kind of holding that 20 billion equity mark. Yet, of course, the revenue has been consistently increasing. So even though assets aren't moving much, the revenue's increasing. So our asset turnover ratio keeps climbing. Our debt ratios basically flat in line. And again, look at that consistency. So this is why I say, again, I kind of stated my case multiple times on PayPal. I know some people agree, some people disagree, but again, in my opinion, I'm seeing a lot of companies that really don't deserve to see these moves, and people are piling in. And believe me, I get it. Don't get me wrong. Because at the end of the day, if we buy something at 10 and then it goes to 13, it really doesn't matter, whether it should have or not. You're up 30%. So, you're excited. You made a great call. So at the end of the day, I understand if this is not necessarily your cup of tea and you're making money elsewhere, it's understandable. But I'm sure you can appreciate my point because, again, we've seen a lot of random micro, penny, smaller cap stocks have these explosions off of kind of like news and reports. And here we have PayPal, who's technically kicking ass and taking names, and the stock is kind of being kept down between like this 55 to 70 range. And in my opinion, I just think it's heating up. I think it's heating up, and I think it's ready to go. But that's just me. But let's look at stock charts real quick. I'll let you go. And you can see the RSI, we ran up here to 70, what was this recent mark? About 62. Looks like we retested that 50-day. We also rejected off the 200-day moving average. And then dropped below the mid-Bollinger Band, bouncing off the bottom, having a little pop today of almost 2%. But we can see the MACD technically recently crossed to the downside, but we might see a slight cross to the downside and now a rally back to the upside, in my opinion. It's really what should happen, but only time will tell. Switch over weekly, RSI basically exactly the same here. 43.5, we'll call it. And look at the tightening. Look at the tightening here in these Bollinger Bands. And this is what I say, in my opinion. Usually when there's a tightening taking place in the Bollinger Bands, that's when you see either a pop up or a pop down. But in my opinion, I really do think they beat this stock up enough. And we just looked at some of the fundamentals. And in my opinion, it really shouldn't go much lower. So I have to consistently reiterate in my eyes that we should have a break up, not a breakdown. Top Bollinger Band on the weekly, about 68.25. In my opinion, that's where it should be. And our 50-day really, fell off a cliff and went from, 260 or whatever it was. Now it's down to 60. Our 200-day hasn't moved too much. Went from about 150 down to about 132.25. But in my opinion, it really should start to climb up now over the next year or two. MACD relatively flat on the weekly for the most part. But let's check the pivot points, actually, and I'll let you go. Like I always say, men lie, women lie, numbers do not lie. And based on the numbers we just looked at, I think it would be pretty difficult for someone to convince me otherwise on PYPL. We could see here we have pivot point about 67 3/4, and you can see we kind of basically hit that level and then reject a couple of times. So this is why I say, in my opinion, I just think it's cooling down, it's quiet, it's out of the spotlight. Excuse me. We have this tightening taking place, and I do think that we start to rally back up. I think something like this pivot point, about 83 1/4, really shouldn't be an issue at all. But again, that's just my opinion. Switch over daily, and we can see. So we were looking, what was the low here? What was the low? What did I say? Was it 56? Yeah, we have 56.39, 54.36. And now you can see this support level at a little over 54. So this is why now, excuse me, my apologies. This is why now, after these rejections off the both moving averages, they might continue to beat it up, actually, and bring it down 3-4 points and retest this level before maybe bouncing it. However, I know today's Friday, we just closed out, and now we have Monday and then Tuesday, which is earnings. So, you know, even though we're looking at a lot of these short-term technicals and the pivot points and the fib levels, we might just rally back up here Monday, Tuesday, get back up to 60 above this neckline, potentially 62, this fib level, going into these earnings. And then if the company beats, in my opinion, it should make a higher high and get above this 70.5 mark, and it should be up here really at like 72.5. But only time will tell. But based off the consistency that we've been seeing from the company with earnings on deck, in my opinion, I would more than likely give them the benefit of the doubt. And that's pretty much it. I stated my case. And again, see, the thing is, people get impatient, right? And it's understandable. It's human nature, you know. If we buy a company like PayPal and we're like, oh, everyone knows PayPal, you know, the numbers look good, I'm going to buy this and hold it for a couple of years and it should go up. And then you see it, you know, coming down, you see it flat, not doing anything. So you're like, you know what, screw this. I'm watching other stocks explode. I might as well just buy something else. And then what happens? Of course, it starts to climb up, and that's what I mean. When it's at 80, 90, then everyone's going to be making videos again on YouTube. Everyone's going to say, oh, I got involved. Were you involved? All of a sudden, they were involved, right? Nobody was talking about it, but they caught the move, and you missed out, and this is why you should subscribe, and all this nonsense. So, again, just like Rolls-Royce. It's boring, it's slow, it might take a while, no one's talking about it, no one believes in it. You know what? In my opinion, that's perfect, because that means it is an opportunity to accumulate shares and build a position for that long-term growth. It's as simple as that, really, in my opinion. But that's pretty much it. So I guess I'll end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually pretty quick to reply. If you're involved in this one, used to own it, or are potentially considering maybe playing some options with these earnings on deck next week, let everyone know down in the comments section. Open forum, you guys know that. Also, Discord link in the description of every video. Again, quick reminder, that is free for everyone to join. But moving forward, more importantly, like I always say, I understand that these markets are rocky, they're volatile, they are very uncertain. So I want to wish all of you success. I hope everyone makes a couple of dollars. Thank you for your time, and I hope you all have a good weekend.